Welcome to Stock Market Today, your market briefing with actionable insights on stocks, bonds, crypto, and the events moving markets. Let's get into it. Federal Reserve policy decisions are driving significant cross-asset repositioning as of May 9, 2026. The central bank's cautious stance on rate adjustments is triggering sector rotation in equities, yield curve recalibration in fixed income, and heightened volatility in cryptocurrency markets. Let's break down the actionable trading implications across all three asset classes. The Fed's current federal funds rate target range continues to reflect a delicate balance between supporting economic growth and controlling inflation. According to the Federal Reserve's official communications, policymakers are maintaining a measured approach as they assess evolving economic conditions. This cautious posture is keeping markets on edge, with investors parsing every data release for clues about the timing and magnitude of potential rate adjustments. Market participants are focused on forward guidance, and that uncertainty is manifesting in real positioning changes. The key question driving allocation decisions: when does the Fed move, and how aggressively? Starting with equities, the technology sector is under pressure as investors reassess valuations in this higher-for-longer rate environment. Large-cap tech stocks are experiencing increased volatility, with specific examples highlighting the broader trend. As reported by Capital Street FX and Yahoo Finance, AMD faces notable trading pressure despite robust first quarter 2026 sales forecasts. This disconnect between fundamental performance and price action reflects the valuation reset underway across growth-oriented technology names. The sector rotation is unmistakable. Money is moving away from high multiple growth stocks towards cyclical sectors, particularly industrials and financials. This isn't speculation, it's showing up in fund flows and institutional positioning data. Value-oriented investment strategies are gaining traction as the opportunity cost of holding cash decreases in a higher rate environment. According to analysis from Kavoot, the S&P 500's composition reflects this evolving dynamic, with technology maintaining substantial index weighting but facing headwinds from changing investor preferences. Industrial firms and financial services companies are capturing increased attention as beneficiaries of economic resilience and potentially steeper yield curves. For traders, this creates clear tactical opportunities: overweight cyclicals and financials that benefit from curve steepening and economic activity. Underweight or hedge exposure to high valuation tech that faces multiple compression risk. The rotation isn't complete, making selective positioning critical. Fixed income markets are navigating complex dynamics. Yield volatility remains elevated as investors adjust expectations for Fed policy timing. The bond market is pricing in potential yield curve steepening as economic resilience becomes more apparent, creating both risk and opportunity for fixed income portfolios. According to Charles Schwab's 2026 bond market outlook, duration risk management has become paramount for portfolio construction. The barbell strategy, balancing short and long duration exposures, is gaining adoption among institutional investors seeking to manage interest rate risk while capturing yield. For conservative investors, capital preservation strategies are taking precedence. As reported by Practice CFO, the focus is shifting toward liquidity management in uncertain rate environments. The traditional 60-40 portfolio is being tested, with alternatives gaining consideration as diversification tools. The actionable insight for bond traders: duration positioning matters more than ever. If you're expecting the Fed to hold rates longer, favor shorter duration to minimize price risk. If you anticipate economic softening triggering eventual cuts, selective long-duration exposure offers appreciation potential. The middle of the curve offers the worst risk-reward in a volatile environment. Cryptocurrency markets are demonstrating continued sensitivity to Federal Reserve policy through multiple transmission channels. According to KuCoin's analysis of FOMC interest rate decisions and cryptocurrency, digital assets remain closely correlated with traditional risk assets during policy uncertainty periods. Liquidity conditions directly affect demand for speculative investments, and the cost of capital influences crypto market participation. The correlation between crypto and equity risk appetite is particularly strong right now. Bitcoin and major altcoins are moving in tandem with high beta tech stocks, reinforcing their classification as risk assets rather than inflation hedges. Volatility spikes around Fed communication events continue to create both trading opportunities and risk management challenges. According to JP Morgan Global Research on Fed rate cut expectations, market participants are closely monitoring inflation data and its policy implications. This macro sensitivity is amplified in crypto markets, where leverage and speculative positioning magnify price swings. For crypto traders, the strategy is straightforward. Treat digital assets as high beta risk exposure in the current environment. When traditional markets rally on dovish Fed signals, crypto likely outperforms. When hawkish messaging emerges, crypto faces outsized downside. Position sizing and risk management become critical given this amplified volatility. Federal Reserve leadership dynamics add another layer of complexity. According to the Federal Reserve's January 2026 FOMC minutes, internal policy discussions reflect diverse perspectives on optimal monetary policy. This debate between growth accommodation and inflation vigilance creates uncertainty that markets must navigate. Forward guidance communication remains crucial for market stability. The Fed's messaging about policy objectives and decision-making frameworks directly influences asset prices across all classes. Coordination among Fed officials to maintain consistent messaging helps reduce unnecessary volatility, but divergent viewpoints occasionally surface, creating trading opportunities for those monitoring communication closely. Fiscal policy interactions also matter for cross-asset positioning. Legislative developments under consideration, including potential consumer-focused legislation and tax policy changes, could affect economic growth trajectories and complicate the Fed's policy calculus. Government spending priorities and their macroeconomic implications create additional variables for the central bank to consider. The interplay between fiscal and monetary policy will shape market dynamics throughout 2026. Expansionary fiscal policy could keep the Fed in restrictive mode longer, while fiscal restraint might provide room for earlier rate cuts. This dynamic requires ongoing monitoring. Current market positioning reflects these cross currents. According to Forbes' analysis of Fed meeting impacts on investors, institutional allocations show reduced exposure to high valuation growth stocks, increased allocation to value-oriented and cyclical investments, and defensive positioning in uncertain policy environments. Risk management is the dominant theme. In fixed income, duration risk management tops the priority list. In equities, sector diversification strategies are replacing concentrated growth bets. Across all asset classes, liquidity management ensures the ability to adjust positioning as conditions evolve. VanEck's research on preparing for Fed rate cuts highlights the importance of maintaining flexibility in investment approaches. The economic and policy landscape continues evolving, making rigid positioning dangerous. Traders who can adapt quickly to changing Fed signals will outperform those locked into static allocations. The economic outlook provides context for these positioning decisions. Current conditions suggest resilient economic fundamentals supporting continued expansion, with moderate growth expectations for the remainder of 2026. Labor market dynamics remain solid, though careful monitoring continues. Inflation considerations remain front and center for Fed decision-making. Core inflation metrics continue influencing policy discussions. Energy and commodity price fluctuations affect overall price levels, while service sector inflation trends require ongoing attention. The Fed's dual mandate keeps inflation data releases as high-priority events for traders. Global economic interconnections add complexity. International growth trends affect U.S. economic performance. Trade dynamics and cross-border financial market linkages mean domestic policy doesn't operate in isolation. Divergent global central bank policies create currency and capital flow implications that cascade through asset markets. The actionable framework for navigating this environment: monitor Fed communications relentlessly, particularly economic assessments and forward guidance language changes. Track inflation data and labor market reports as primary policy inputs. Watch yield curve dynamics for signals about market expectations. Observe cross-asset correlations, especially between equities and crypto, for risk sentiment insights. Portfolio construction should emphasize diversification across sectors and asset classes, active duration management in fixed income, tactical sector rotation in equities, and disciplined risk management in high volatility assets like crypto. Flexibility trumps conviction in uncertain policy environments. The Federal Reserve's May 2026 stance creates both challenges and opportunities. Equity markets face valuation pressures, but sector rotation offers tactical plays. Bond markets navigate yield volatility, but curve positioning enables risk-managed returns. Crypto markets amplify broader risk trends, but provide high beta exposure for appropriate allocations. Success requires staying ahead of policy signals, understanding cross-asset implications, and maintaining the discipline to adjust positioning as conditions evolve. The traders who synthesize Fed policy, economic data, and market positioning will identify the highest probability opportunities. That wraps your market intel. Trade smart out there. For deeper insights and real-time analysis, visit capitalcopilot.io.